All right, well, markets are adjusting to a new regime of greater volatility and higher interest rates. This is starting to create some opportunities, according to BlackRock. Now, the global investment giant highlighting three key themes right now. Number one, hold tight. As the U.S. is navigating two large and unprecedented shocks, a shift in consumer spending and a worker shortage. Number two, pivot to new opportunities. They say that greater volatility has brought more divergent security performance relative to the broader market. And third, harness megaforces. There are structural changes the firm thinks are poised to create big shifts in profitability across economies and sectors. Well, joining us now for that and more, we want to bring in Wei Li, BlackRock Investment Institute Global Chief Investment Strategist. Wei, it's great to see you here. So just unpack exactly, I guess, how we're set up entering the fourth quarter. We were able to avert a government shutdown, at least for now, but we're not seeing a lot of relief in the markets for the second day.
Right now, the lens to look at what's happening in markets is through rate repricing. And 10s is now above 470, which is a meaningful push higher versus pre-summer levels and also versus beginning of the year. At the beginning of the year, we had the view that rates would stay higher for longer, but I think that was somewhat contrarian because markets were pricing for rate cuts of 100 basis points by Q1 next year. But now, in terms of the rate path repricing, the policy rate repricing, markets are getting closer to where we think is fair, which is higher for longer. Yes, we're going to have cuts later next year, but not as much as during the old regime, because now central banks, in the face of structural supply constraints, will have to have a tightening bias versus the easing bias that we got used to during the great moderation from the mid-80s to pre-pandemic. So policy rate repricing has come a long way, but term premium repricing is just getting started. So term premium, which is defined as the additional return that investors should demand for holding long duration in portfolio, well, it has been deeply negative for a very, very long time. But more recently, term premium is starting to come back to closer to zero, but historically it could get to 1%. So rate path repricing has come a long way, getting closer to where we think is appropriate. But term premium repricing, reflecting the higher macro uncertainty, reflecting inflation premium that has been non-existent for a very, very long time, reflecting greater issuance, treasury issuance. So all of that should push rate and term premium higher, which is why we're not quite dipping our toe back into U.S. long duration, but we're finding after recent rate repricing opportunities emerging in developed market international duration. So we turned overweight in European government bonds, in UK government bonds, where we're closer to peak rates. And we also continue to like selective opportunities in equities, like in Japan, like in selective sectors in the US, such as energy, consumer discretionary, and AI as a mega force. So be very selective as equities reprice to the higher for longer rate dynamics, and continue to monitor where value is being created from rate repricing in a fixed income space, because bonds are certainly back for income, not quite for diversification, but for income role in portfolios.
And so, Wei, when we think about higher for longer, Wei, what does that longer time span look or feel like? Do we have anything that we can point back to in the past even that would suggest that, at least for the calculus that we've started to see come forward from some economists and people who we've interviewed, the time span that's been thrown out there for a cut is Q2 2024, and some instances even before that. So it seems like higher for longer firmly takes that off the table.
Well, we do think that the Fed can cut rates, right? So higher for longer doesn't mean that they won't be able to cut at all, but the magnitude to which they come to the rescue of economic slowdown will be a lot more limited in this new environment of greater constraint for central banks in the face of supply shortage versus during the great moderation, when productivity capacity was plenty and central banks were able to readily come to the rescue of economic slowdown. So yes, we see them cutting rates second half of next year, 2 cuts maybe, then take us into the year after. but where they land, this terminal rate and long-term neutral rate, while we're looking at higher than previous R star, than previous equilibrium rate, reflecting the greater macro uncertainty, reflecting the new regime framing, and that is starting to be appreciated by markets if you look at recent rate repricing, but there could be more to go. And together with term premium returning is why we think that there could be greater room for yields to push higher, for 10-year yields to push higher. Now, the good news here is that rate repricing, policy rate repricing, should be negative for equities because of higher discount rates. But term premium returning, rate repricing because of term premium returning, doesn't have to be negative for equities because it's just around kind of the appeal for duration in portfolio. So if we're looking at more term premium repricing going forward, that doesn't have to be negative for equities, but equities have yet to reflect the higher rate repricing as well as the lower kind of trend growth. Currently, markets are looking for margin to grow, earnings to rebound, but maybe against the backdrop of stagnating growth, that could be a bit more rosy, which is why we want to be very selective in equities.
Wei, we got to leave things there on the day. Thanks so much for joining us to kick off the morning just outside of 15 minutes before the opening trade here, or the opening cross. Thanks so much, Wei Li, BlackRock Global Chief Investment Strategist. Appreciate it.